Good evening, Marshall Reddick investors, and thank you for joining us tonight for our presentation on how to buy investment property. My name is Kristen Tabar, and I will be your hostess with the mostest tonight. And I'm really excited to have everyone joining us tonight. This is one of my personal favorite topics to cover, and I am excited for tonight's presentation, and I hope all of you are as well. So for those of you who are new to Marshall Reddick Real Estate, we are a full service, one-stop shop brokerage. Our headquarters is here in Newport Beach, California, and we also have offices now across the US in San Antonio, Texas, and Clarksville, Tennessee. We also work with vendors and partners that we've built over the years so that we can provide all of our clients with connections to lenders, CPAs, insurance providers, 1031 exchange accommodators, and many, many, many more people. Anyone that you could possibly think of under the sun that is going to be part of a real estate transaction for you, we can help you make those connections. So we really are able to save our clients a lot of time and energy in providing those connections for them. So a little bit about me. As I mentioned, I'm an advisor here with Marshall Reddick Real Estate. I've been with the company for 4 years now. And a couple of pictures of my kiddos there. I'd like to give you guys more than just a standard headshot, so you have a little bit of insight into who I am and who you're listening to. I've been investing with Marshall Reddick since before I became an employee. Funny story, my husband actually went to high school with our VP, Scott Pastel. And at the 10-year high school reunion, we got to chatting, and Jason, my husband, and I were investing, and turned out Scott's company helped people do exactly that. So it was a match made in heaven, if you will. And I actually had the opportunity to start working with the company just a few short months later. So really excited to be able to tell all of my clients that I do practice what I preach. And to date, I have helped on 234 transactions for my clients through Marshall Reddick and our team. So if you guys have questions along the way, please feel free to type them into that panel. I'm going to do my best to answer them as we go. I'm usually joined with another teammate on these webinars, but tonight I'm all by myself. So I want to make sure we get to the information. And if we have time at the end, I promise, I will get to those questions, and we will see how many we can get through. So here's a quick snapshot of what we're going to cover today. It's really a jam-packed presentation. As I mentioned, it's one of my favorite ones to cover because you guys will get a little bit of everything tonight, from how to set investment criteria to property management and everything in between. So for those of you who are brand new to investing, this is going to be maybe a little bit of a refresh, or for those of you who are not brand new to investing, sorry, this will be a little bit of a refresher. And for those of you who are brand new to investing, you'll get to see kind of firsthand how to get started and what role Marshall Reddick plays in working with our clients who are both beginners and who are seasoned investors. So we're going to kick off the presentation with a poll question. I always like to get an idea of who is joining us. And when we do this presentation live, I get to ask everybody by show of hands, but don't have that option tonight. So first I want to find out, does anybody currently own any rental property? So if you guys can go ahead and take a couple seconds, this information is private, I promise, it's for my eyes only. I just want to get an idea for who is joining us tonight and what the experience looks like out there. I will share the results, but no names or anything will be attached to that. So I'll give you guys just a couple more seconds to give me an idea of what you currently have in your portfolio. And 3, 2, 1, we'll go ahead and close that out and share the results. So pretty close to what I expected. About 71% of our attendees tonight don't own any property yet. And you came to the right place to get a bit of a foundation on how to get started. 18% own 1 or 2 properties, and 9% are at 5+. with 3% at 3 or 4. So good range there for those of you who own property. Really excited to learn more about that. And for those of you just getting started, I would love to learn more about why you registered for tonight's event and how we can help you go farther. So without further ado, let's hop on to the next slide. Where do we begin? A lot of clients that I speak to for the first time say, Kristen, I've been interested in investing for months now, but I just don't know where to start. So let's dive right into it. One of the cool things that Marshall Reddick does as a company is we offer our clients a free consultation and mentor everyone through the entire process. So as an advisor, I'm involved with my clients as much or as little as they'd like me to be. And I am willing to and do frequently hold my clients' hands throughout the entire transaction, whether it's their first or their fifth or their 10th. We always want to make sure that everything goes smoothly. So that's what I'm here for. So what does that consultation look like? Well, first we're going to talk about what your goals are. Why are you interested personally in investing in real estate? And this is going to be different for every single investor. Next is going to be our how, and this is going to evaluate your options on purchasing. Are you paying cash? Are you planning to finance? Where are your funds coming from? And so on and so forth. Next is your time frame. Is it 6 months from now? Is it 1 year from now? We want to make sure that we're working at a pace that's comfortable for all of our clients and all of the parties that are involved. We want to set your investment criteria so that we know exactly what it is that you're looking for. And we'll dive into all of these things a little bit later on. Setting your criteria is going to be, the type of property that you're looking at, which market fits with your criteria and your timeline and your purchasing options. And then finally, introducing you to the team, if you will, that will be helping us through the transaction. So we like to call real estate a team sport here. And everyone from your advisor to your agent to your lender is going to work together very closely to ensure that the transaction goes smoothly and that at the end of the day, you are a happy camper with a new investment property. So first is the why. As I mentioned, people have many different reasons for wanting to invest in real estate in general. For some people, it's long-term wealth and retirement. For other folks, it's supplementing a current income. Some people like to travel. Some people want to spend more time with their family. And the list goes on and on and on. For my husband and I personally, we would like to work less and make more and spend our time with our kids and traveling and doing things that we like to do in addition to, being able to invest and work so that we can continue to earn income and able to do so. So as we go through the presentation, I want you guys to think about your own personal goals and what investing will do for you to help you get there. So next we're going to talk about setting your personal investment criteria. So there's a lot of things that go into what type of property we're looking for. Price is going to be a big one, property class, which we'll get into later. And as you start to see these different items, you'll see that they all are really going to play a part in the selection of property, and they're all going to work together. So the price in any particular market is going to determine the property class and the property type that our clients are able to afford in that particular area, and then the condition of that property as well. So if you're looking for a single family property in San Antonio that's B class, that doesn't need any repairs, that's going to be a much different price point than, perhaps a duplex in Cape Coral, Florida that needs a ton of work and is an A-class property. So we're going to dive into those things as we go through the presentation, and you'll start to see how everything starts to work together to create your investment strategy. So diving a little farther into the criteria, these are some of the questions that I will ask my clients on our consultation. And this kind of goes back to what I was mentioning a couple slides ago. What are your goals? And how do your goals affect the criteria when we go to look at property? So I'm assuming that since you guys are on tonight's presentation, you can read. So I'm not going to read all these questions to you, but as you look at these slides and look at some of these things, I want you to start to ask yourself those questions. For some of you that are maybe closer to retirement age, how many years is that for you? How long do you have to start building the portfolio now that's going to help you make that retirement comfortable? So let's jump into property classes. As you can see here, the property class is going to be based on the purchase price in that particular market. So all markets and all purchase prices are not created equal, if you will. The median home price, which is going to determine your property class, is going to be different from market to market. So an A-class property in Orange County is going to have a much different purchase price than an A-class property in Clarksville, Tennessee, for example. So the way that that's broken down is your A-class property and your B-class property are going to split the line of that median home price. So that graph at the very top, SFR, that is your single family residence. And for easy math, if your median home price is $100,000, any value from $100,000 to $130,000 is going to be your A-class property. An $80,000 to $100,000 property will be B class, and your $50,000 to $80,000 property will be C class. So what Marshall Reddick does as a company is we encourage our clients to look at A, B, and C class properties. And the reason for that is that if you get into the luxury type properties, now we're getting into a purchase price and a rental amount that is going to exceed what most renters are able to pay. And it's also going to be a little bit out of the realm of people who are going to rent anyways. On the other end of the spectrum, when we get down into the D-class properties, these are areas where the income level is significantly lower and the tenant quality also tends to be very poor. So we like to stick in the A to C class range as it improves the tenant quality for our owners and also keeps us in a realm of high rental demand. So a good way to remember the difference between an A, B, and C class property is to take a look at the graph below. Your A class properties are going to favor appreciation. These are going to be the properties that are going to increase in value a little bit more quickly and more steadily. And they are going to generally be on the higher side when we're talking about purchase price. Now on the other end, where the C-class properties are going to be is going to lean more on the side of cash flow. So we generally see a lower purchase price, a higher rent to purchase price ratio, but we're also looking at a little bit lower tenant quality than you're going to find in that A-class range. And your B's are going to be both. So A, appreciation, C, cash flow, B, both. So some of you might be thinking, Kristen, why would I buy a C-class property, or who buys those types of properties? Well, the C-class properties, as I mentioned, are going to be a little bit higher in the cash flow. So your folks that are closer to retirement age. I'll give you an example. I have a couple of clients, they're in their early 60s, planning on retiring very soon, and they have been slowly acquiring a portfolio of C-class properties over the last 4 years so that when they get to their mid to late 60s, they can retire with a handful of properties that produce a steady, strong income on a monthly basis. So that C-class property is going to be good for those folks who don't have as much time to wait for their property to increase in value, but rather need that income more rapidly. On the flip side, I work with many clients who are in their mid to late 20s, early 30s, and they're looking at just getting started, are going to work for the next 30 to 40 years, maybe, who knows. And those clients have time for their property to appreciate in value, and maybe the monthly income isn't as important. So while they don't necessarily want to have a property that's negative monthly, the immediate cash flow is less important than the projected value of that home and what they might be able to do with it later on down the line. So gives you a little bit of an idea of what you can expect in the different property classes. So let's dive a little bit more into how we figure out, what we're looking at in each particular class. So the median home price of any given market is going to be what is going to set the standard for that property class. So the example I gave earlier, if the median home price in the market is $100,000, that's going to split the line between A and B. So there are going to be some other factors if your property is on the line that are going to tip it in one direction or the other. Some of those factors that are important are the crime ratings in the area, also the school ratings, and the price per square footage. So as you're starting to evaluate property and you're looking at something in an area where the median home price is $100,000, and you are looking at a home and you think, which way would this go? If the schools are rated 8 and above, and you look at a crime map and the area around it is green, you're able, in my personal opinion, what Marshall Reddick would do is put that into the A category. Now, if that property had school ratings that were maybe 4 or 5 and crime ratings that were a little bit higher than very low, then that might put you in the B class. So usually at this point, I would ask if anyone has any questions. Again, if you have questions, please type them into your box and I'll do my best to get to them within the hour. And in the meantime, we will move right along so that you guys can get a little bit of a snapshot of what you can expect from a tenant quality perspective in each different property class. Down at the bottom of this flyer, you can see what I just mentioned as far as things that matter when we're determining property class and things that don't matter very much. The type of property is not going to have much of an effect. What we're looking at is the price per unit. So as you start looking at duplexes, triplexes, fourplexes, and you start increasing your unit count, the important thing is going to be the price per unit, not how many units there are. So keep that in mind as well. Also, property condition. A lot of people say, well, Kristen, this is a brand new property. How come it's B class? Well, it doesn't matter that the property is brand new. The location is important, and the cost per square foot, school district, and crime ratings are what are affecting that property's class, not the age. So the age is not going to play a role in determining the property class. So let's talk about maintenance and vacancy. For those of you 30% or so that have joined us tonight that already own rental property, you guys know that at some point you will experience maintenance and vacancy. For those 71% of you who are joining us tonight that don't own property yet, as you are evaluating different companies and deciding who you want to work with, if you don't see estimates for maintenance and vacancy, your spidey senses should tingle, because at some point you will have tenant turnover and there will be things in your property that you're going to need to fix. So those estimates are going to come from the property class. Earlier I mentioned that your A class property is going to have a little higher tenant quality, and so that tenant is more likely to take good care of your property. They're going to treat it with a little bit more pride of ownership. On the other end, your C class tenant may be a little bit rougher on the property. An example that I like to give usually gets a laugh when I'm doing a live event, so I'm going to imagine that you guys all chuckle a little bit as well. Your A-class tenant may spill a glass of wine and immediately jump up to grab a towel and clean it up. Your C-class tenant may spill that same glass of wine and go, it's a rental, and they may not move as quickly to clean it up because it's not as important to them to maintain their home and take care of it. So your B class, again, is going to sit there right in the middle. About half of them are probably going to be drinking a nice bottle of wine, and they're going to not only be bummed that they spilled it, but they're also going to want to clean it up. And the other half may be drinking wine from a box, and it's not a big deal that it's spilled, and they don't care if they're going to clean it up. So that's for 1 to 4 units. You'll see A class, we estimate 8%, and that percentage is part of the monthly rent amount. So 8% for A class, 10% for B class, 13% for C class, and then that's going to change just a little bit when you get into the 5+ units, and that's because with more tenants, there's usually a little bit more maintenance that's going to be required at some point. Vacancy, you'll see, though, will remain the same. So to give you guys an idea of what that maintenance and vacancy looks like, for the vacancy, 8% equates to about 1 month per year. So as you're looking at the Marshall Reddick financial calculator, and we will get to that a little bit later on, you'll see that we estimate 1 month of vacancy per year. It's very conservative. Generally speaking, your tenants are going to sign 12-month leases. So the expectation is not that your property will be vacant for 1 month a year, but rather that if you tuck away 8% of the monthly rent per month, you will accumulate 1 month's rent during the duration of your tenant living there and essentially be able to cover expenses when there is a vacancy. So for a little bit more information on the rating system and how we arrive at those property class ratings, we do have a free download on our website. It's about a 20-minute read. It's the Reddick property rating, and it's going to really walk through all of the methodology behind how we arrived at this rating system. And also, for those of you who are looking at maybe purchasing properties that need a little bit of work, there's some equations in there to help you determine what your after renovation value might be, depending on the dollars that you're going to be spending on the renovation, etc. So again, that's a free download on our website. Some of you may have read it already, and this is a refresher course. Others of you may be looking for a little bit more info or clarification on the rating system. Either way, it's a quick read and really informational. Many of our clients like to read it multiple times, especially as they continue to build their portfolio and are looking at diversifying the types of properties they're in. So moving right along to where we are going to invest in real estate. So how do you decide? There's lots of different ways to determine which market is a good fit. Oftentimes it's based on price point, and then from there it's based on several other factors. So let's hop on in. Here are just a few of the things, 6 very important criteria that Marshall Reddick as a company looks at when we are looking at rental markets. A question I get a lot is, are we going to expand into new markets? There's not a short answer to that. We're constantly evaluating markets across the nation using these and other criteria. What we're looking to do is aim for quality over quantity. So it's not just a matter of having a great job market and a strong education and workforce. It's also about being able to build a strong team in the area and looking at it from a longevity standpoint. So we always want to have 15 markets and options for our clients. And what we've done in the last few years is we've cycled a few of them out. Some of them are long-standing, and a few markets we've been in for just a few years, but they've proven to be successful investment markets for our clients. So if that was a question that you had as well, keep in mind that if we're not in a market today, it doesn't mean that we may not be in the future. It also doesn't mean that we will be in the future. So for now, we have 16 markets across the nation that we have excellent teams in. The markets that you see outlined in red are where we actually have Marshall Reddick teams and offices. So in the markets that you don't see a red box around, we work with third-party agents and third-party management teams that assist our clients through the contract process and with management. And where you see the red boxes means that from the time you start speaking with me or your advisor to the time you get connected with an agent to your management and for the life of your investment, you're always going to be working with the Marshall Reddick employee and the Marshall Reddick team. So we're really excited about that. And eventually we won't need those red boxes anymore, because the goal is to be able to take over all of our markets so that we have control of our clients' experience, and we can really make sure that from start to finish, you guys are taken care of with the quality and service that you expect and that we want to give you. So as you're taking a look at the map, again, I would love to be sitting in front of you guys to get an idea of what areas are of interest and whatnot, but we'll go ahead and skip right on to the next slide here. So in those areas where we have our teams and we have a strong investment market, we want to stick to the suburbs of those major metropolitan areas. So here's just a quick snapshot of a few of the markets that we're in. From California to Florida and everywhere in between, we always want to target the suburbs of major metropolitan areas. So why is that? Well, because if any of you have ever driven to Las Vegas, which by show of hands, I'm sure it's many of you that are on the call tonight, as you're driving on the 15 and you've been driving past nothing, and all of a sudden you see a little cluster of homes, and then you keep driving and you see nothing, those homes may have great low purchase prices, but who wants to live there? I don't want to live in the middle of nowhere, and I certainly don't want to own a home that's in the middle of nowhere, because my guess is that there's a lot of other people who don't want to live there either. So we want to stay away from small towns and areas like that that have very low tenant bases, because we want to be able to have the largest pool of potential renters that we possibly can. This is going to reduce our vacancy potential, and it's also going to reduce the length of your vacancy in between when your tenants are placed. So larger tenant base, diversification of employers. Where do you think people who live on the side of the 15 in the middle of nowhere work? We want to make sure that there's a lot of job opportunity, because if our tenants fall onto any kind of hardship or they lose their job and they're not able to find another one, then that in turn makes it difficult for a landlord to collect rent. There's also more selection of professional property management. For those 30% of you on the call that already own property, if you do use the services of a professional management company, you know how important it is that they are timely with responses, that they get contractors out to your property very quickly when there's a problem. And if you're in a small area where there's not a high volume of rentals and there's not many choices of property management, and you're limited to maybe one company that performs very poorly, that's going to negatively impact your investment as well. We also see The major metropolitan areas have a higher chance of population growth, and that's for future job opportunities. It's people that are moving there now who plan on settling down and having families. A lot of things contribute to future population growth. And then, of course, larger areas where there's more demand for housing means that your value of your property is more likely to increase. So we want to stick to those major metropolitan areas, and then we want to stick to the suburbs. And I will click these up really quickly so you guys can start to take a look at that. The suburbs will attract families who are looking specifically at maybe having their kids start school young and going to the same school or staying in the same district through high school. Maybe they've been with a company for several years and now they're looking at and they're looking to stay near their work. They're moving to be closer to work. They're looking to raise their family in an area of lower crime. So there's a lot of reasons that people look to live in the suburbs. I'll give you a personal example. When my husband and I met, we lived in an apartment that was about 4 miles from Main Street in Huntington Beach. And when you're in your mid-20s and you're newly dating and newly married, it's really awesome to be that close to a downtown. We were halfway between Huntington and halfway between Newport, so location was fantastic. As soon as I got pregnant, all the noise bugged me. I didn't care to be near the party scene because now I knew I was going to have an infant, and I have to believe that I'm not the only person who thinks this way. So what did my husband and I do? We packed up and we moved to the suburbs, and now we live in Lake Forest. So that's another reason that we want to target the suburbs, is because if you have a young family or a young couple that's looking to start a family, they're more likely to stay in your property for a longer period of time, which reduces your vacancy and ultimately is going to increase your long-term return. So I want to jump into a little bit of market data for you guys to take a look at, kind of give you some snapshots of the areas that we currently have teams in and why we like those markets. So San Antonio has always been very, very steady. Through the crash in 2008, the most property values dropped was 2.6%. Something very low like that. And their unemployment rate currently is at 3.2%, which correlates directly with the vacancy rate as well. A low unemployment rate also means a low vacancy rate, which is great for property owners, as if your property is not rented, you're not making any money. So low unemployment rate is a great thing for property owners. Texas is on many of Forbes lists quite frequently. Austin is one of our markets as well, San Antonio. The state itself is a low cost of doing business and really desirable. Lots of companies move there frequently, and a lot of people move to Texas out of California for the same reason, the lower cost of living, jobs are abundant, and it makes sense for a lot of people to do that. Here's San Antonio again, quick picture of their diverse job, their diverse economics. Cape Coral was number 2 on the hottest real estate markets to, hottest real estate markets to watch in 2017. Again, that data is a little bit old, but Cape Coral continues to make lists like that as well in terms of affordable areas in the nation, best markets to invest in. And you'll see those of you on the line who follow lists that are published by Forbes or CNN or other major players that are constantly tracking that kind of data, you'll see several of our markets pop up on those lists year after year after year. Here's some info on Orange County. A century low 3% unemployment rate this year, which is huge for those of you who are looking at or already own property in Orange County. Our home market, so we love it. And it's really exciting when we see statistics like this in our own backyard, if you will. Best cities to buy rental property in California for 2019. Los Angeles and Hawthorne. There's many different reasons for that. Big football stadiums going up. There's a lot of exciting things happening in the LA area. So again, those of you who are looking at investing closer to home or already own here, definitely keep an eye on those values and keep an eye on those areas. Another data snapshot of Indianapolis and Memphis, one of the 10 best cities to launch a startup. So as I mentioned, our markets are popping up on these lists of, 10 best cities to do, you name it. And these are the reasons that we continue to encourage our investors to look into these markets. If you're interested in more detail on any of the markets that I mentioned, or if I didn't specifically talk about somewhere that you're interested in and you want to learn more, we do offer free market data packets on our website. They are updated annually, and some of them have already been updated for 2019. So you can get the most recent, most up-to-date info on the demographics, the economics, even such things as what folks do for fun when they go to the area, what does the vacationing look like, things to that nature. So anything you need to know, there's a lot of graphs, a lot of details. So I definitely encourage you to check those out. As I mentioned, it's free, so that's always nice. Our website itself offers a myriad of other information as well. There's videos that you can watch for those of you who don't like reading, and there's also articles that you can read for those of you who don't like watching videos. Hopefully none of you are here tonight because I'm making you watch my video. Anyway, so definitely take advantage of that Learn page. And if you guys have any questions about anything that you read or want more information, please, please, please don't hesitate to reach out and we will help you with that. So moving right along, we've talked about the why, we've covered the what, we've talked about setting your investment criteria. So let's talk about how. Which purchasing method is the best one for you and your particular investment goals? These are just a few means by which our clients purchase inventory. For those of you who are new to investing and here tonight to get started, the conventional finance option, cash, maybe a retirement account, or private financing are most likely going to be the ones that you're going to be looking at, as the others require you to either own a property already and pull cash out of it, or own a property already and sell it as a means to have a down payment for a replacement purchase. So we're going to spend a little bit of time tonight covering some conventional financing details and also private financing. And again, for those of you who are interested in performing a 1031 exchange or want more information on a line of credit or some kind of cash out refinance, I'm definitely happy to walk through that with you as well. For now, we're going to talk about conventional financing. Conventional financing is usually the best method for our investors to purchase property, as it has the lowest down payment requirements for a non-owner occupied property, and generally the best interest rates as well. And you'll see the difference in private financing when we get to that. So what you will need as part of a conventional loan offer is an approval letter. Whenever you make an offer to buy a property, you're going to have to include proof of down payment funds and an approval letter from your lender. So what that looks like is submitting documents to your lender, having them reviewed, and then getting a number that confirms your buying power. So what your lender will do is run all your documentation, check your credit, look at your debt to income ratio, which we'll get to in a minute, and give you a number that says this is the maximum purchase price that you can afford. And why you want to do that before you start shopping is because you want to make sure that you're not shopping for a Ferrari on a Honda budget. We don't want to be looking at $500,000 fourplexes when maybe your approval amount is $200,000. So it's always really important to connect with a lender and confirm your buying power so that you know what purchase price you're looking for. And also, if your lender's a good lender, they'll break down the payment information for you as well so that you can see, okay, if I buy a $200,000 property and I put 25% down, what are my payments going to look like monthly? What can I expect for that to be on a consistent basis so that I can make sure that when I'm looking at properties, I am comfortable with what that rental amount is, with what the taxes or insurance amount might be, because those are going to vary from state to state and even individual markets within that state. So it's really important to connect with the lender as one of your first steps so that you can get an idea for what your buying power is. And then that'll help you to determine your price point and then what you're looking for and then what market is suited for you. And hopefully for those of you who are new to Marshall Reddick and new to investing, you're starting to get an idea of how all of these things really are intertwined and play a role in how we prepare ourselves to invest in real estate. So we're going to skip along to the down payment requirements. For those of you who have not purchased a property within the last 10 years or have not purchased a property ever, the down payment requirements are going to be different for a primary residence that you're going to live in and a rental property that you are not going to live in. So for a single family, your minimum down payment is going to be 20%, always 20%. It doesn't matter if it's your first property or your fifth property or your 10th property. Your minimum down payment is going to be 20%. For a 2 to 4 unit property, you're going to be looking at a 25% down payment minimum. Same thing. And this has changed recently. The down payment used to increase 5% for properties 7 through 10, but that guideline has been loosened a little bit recently. And so now the minimum down payment requirement is that 20 or 25% up until your 10th property. And you are allowed to have 10 financed properties. So that's another thing that we want to consider as we're talking about how to grow your portfolio is that once you get to that 10th one, you need to start paying off other properties or paying cash for future acquisitions. So you can see here on the screen what the credit score requirements are. And obviously it's going to get higher as you get higher in your unit count, your property count, because at 7 to 10 properties, you're considered a little bit higher risk as a borrower. So we work with Reed Hazard is our preferred lender, and he has worked with hundreds, if not maybe thousands of our clients to help them purchase rental properties and primary residences. They are located, he and his team are located in San Clemente, and they are always available to hop on a call. You can do your applications online. You can do your application over the phone. And for those of you who are on the line tonight and are interested in getting connected with Reed, whether it's to get a pre-approval because you're ready to start shopping or because you have questions on any conventional financing that I maybe didn't cover in this little short period of time, you can definitely email me or give me a call, and I'm always happy to make that connection. As I mentioned earlier, we pride ourselves on being a one-stop shop for our clients. So anything that you guys need, any connections that you need or info, please don't hesitate to reach out. So with that, we're going to hop into private financing options. As I mentioned earlier in the presentation, Marshall Reddick is a full service brokerage, private money lender, and property manager. So we have a private lending team in the office, and they offer our clients the opportunity to borrow money if they're purchasing with a self-directed IRA, if they're purchasing with an LLC, or if they've exceeded that 10 conventional loan maximum that I discussed a couple slides ago. So there's many reasons that people look at a private finance option, and we offer that to our clients. Here's a snapshot of what those loan programs look like. And again, if you are looking for more information or you're looking to borrow money in a private loan capacity, I can hook you up with the team and make sure that you get all the details and information that you need. So let's go from financing to asset protection. And I do apologize. I know we're moving very quickly, but it's 7:15 and I want to make sure that I get you guys out in time for dinner. So I'm going to hop through asset protection quickly. And what that is your property insurance. So if you are getting a conventional loan or a private loan and financing a property of any kind, your lender is going to require you to have insurance. So number one reason you need insurance is to satisfy your lender. What's even more important than that is to protect your asset against anything, against any kind of natural disaster, against anything unforeseen. So you want to make sure that you have a comprehensive insurance policy that fits with your financial needs, that also fits the coverage that you're comfortable with. So you want to make sure that you're covered for what may happen in that area, damage to the home. In some areas of Florida, maybe it's flood insurance, maybe it's hurricane insurance. In some areas of Texas, it's wind and hail. In California, as many of you felt last week, maybe it's earthquake insurance. Maybe you don't want any of that coverage, and that's fine. Again, everybody's different and everyone's wants and needs are going to be different, even when it comes to the insurance coverage. So the best thing to do is speak with an insurance provider and let them know, kind of what your concerns are, what your worries are, and they can help you to compose a policy that really works for your needs to make sure that you're comfortable. Now, what a lot of my clients will do as well is, in addition to their regular insurance policy, they'll get an umbrella policy. And what that umbrella policy does is it's going to cover from your regular coverage up to whatever that dollar amount is. In most cases, it's $1 million umbrella policy. And that's a good way to keep your assets protected from anything unforeseen. Definitely want to make sure that you're covered. So let's dive into how to evaluate returns. We're going to start with return on investment, which is generally going to be heavily weighted in appreciation and how that property is going to increase in value. So tonight we're going to use an example from Orange County. And what you're seeing here is a snapshot of the market. So you can see that for a single family residence, the median home price is $820,000. And for a multi-unit, per unit for an A-class, median is going to be $574,000. So what that means is if it's a duplex, a triplex, a fourplex, each unit is going to be valued at $574,000 or more to put it in that A-class category. And for a single family, anything above 820 and below $1,066,000 is going to put you in that A class. So above that, you can see a graph of the Orange County market. And it's not quite the roller coaster ride that Cape Coral, Florida looks like in terms of appreciation, but you do see the hills and valleys. And you can see that since 2008, the market has recovered and since even begun to exceed what those higher price points were back at the height of the market in the early 2000s. So let's take a look at a property. This is a duplex in Eastside, Costa Mesa. There is a 3-bedroom, 2-bath. Both units are rented. And this is an A-class property. For those of you who are familiar with Costa Mesa, Eastside is very sought after for both renters and homeowners. It's close to the beach. It's close to the freeway, so there's easy access to transportation. It's close to the mall. I grew up on Eastside, Costa Mesa, so if I do say so myself, it's a great area to own property. So let's look a little bit at the financials. So you can see the list price here at $1.2 million, minimum down payment of $364,000. And that's showing you a 30% down payment. The reason that we default to that number is because generally speaking, you're going to see better loan terms if you put down 30% on a multi-unit. It usually will bring your interest rate down a little bit, and in some cases gives you a little bit better pricing. So that's the reason that you'll see that there, but do keep in mind that you can put 25% down on a 2 to 4 unit property. So as you go down the list here, you see the gross rent at $5,300 per month. And then under that is going to start listing your monthly fixed expenses. So your fixed expenses are going to be your recurring expenses that you're going to have every single month without fail. So for this particular property, it's taxes, insurance, your mortgage payment, your management fee, and the utilities. And what the utilities are on this property is your water. The units are not individually metered, so that $900 is a fee that the owner must pick up. Sometimes you're able to work that into the rent, other times you just have to incorporate it into your expenses. And so your monthly income on this property, when it's financed in this capacity, is going to be on the negative side. However, as I mentioned, a property in California, especially in Orange County, is one where we're looking more at an appreciation play. So what we're going to do over the next couple of slides is look at what the return on investment is when we calculate much more than simply the monthly income and the down payment amount. So what does that look like? For return on investment, we're going to take into consideration profit from a sale, the total cash that you invested initially, and the number of years that you hold it. So I'm going to show you a snapshot from the Marshall Reddick website. On each and every property, there is a financial calculator that automatically populates with all of these figures. So we default to a 15-year hold because we have found on average that most people will hold a property for about 15 years if it's a rental. And we have conservatively put the appreciation here at 4% for this market. So you can see here that the total projected profit is comprised of the accumulated cash flow, the appreciation, and the principal pay down and selling expenses. So those 4 things are going to equal your projected profit. So The estimate here is that in 15 years, if you sold this property, you would walk away with about $500,000. So if we put that into the equation that I showed you on the previous slide, that brings us to an annual return on investment of 8.69%. So if you are one of those folks that I mentioned earlier, where maybe you've got a really, really great job, you have a very high income, you need tax write-offs as part of your investment strategy, this would be a great property for someone like that, someone where the income monthly isn't as important as the tax benefits, the long-term gain, and what could potentially be done with this property upon selling it several years down the line. So let's switch gears and let's look at a property where the cash on cash return is going to be higher. So we're going to look at Clarksville, Tennessee. You can see just right off the top from the graph on the appreciation, it's slower but steady. There's no big dips, there's no big increases. It's a steady eddy market where the values don't tend to go up or down very significantly at all. The other thing you'll notice is that the median home price is significantly less at $143,000, and in Orange County it was about $700,000 more than that. So there's a big difference in the median home price in these markets and a difference in the types of returns you're going to see between these areas as well. So we'll take a look at a property here. The Clarksville market is one that is very sought after, especially with our newer clients, because we offer turnkey inventory here. And what that means is the properties are rent ready, and generally speaking, they are rented before escrow closes. So what does that mean for you as the buyer? It means that your initial repair cost is going to be minimal, if any, because the property is rent ready and there's tenants inside already. And it also means that you are not going to have to close escrow and then wait for a tenant to be placed. So couple of perks of purchasing a property rent ready. So let's look at the financials and see how this differs from the Orange County property. First and foremost, your list price is significantly less. So for those of you on the call right now who are thinking, you know, wow, I really want to invest, but I don't have $300,000 to put down on a property, maybe this is more within your wheelhouse. Investment capital needed is just shy of $33,000 at 25% down. And that's a much different point of entry for a single family home than it is here in California. So rent on this property is $900. Remember, I said that it's already rented. So that is an actual rent amount, not a projected rent amount. And the holding costs are your fixed expenses. Again, your mortgage payment, taxes, insurance, management. Generally for a single family, the utilities and the landscaping are all going to fall on the tenant. So multi-units are a little different. Sometimes it's hard to determine who's going to mow the lawn because two people live on the property. But for a single family, those expenses are going to be picked up by your tenant. And your fixed monthly expenses on this property are $600, making your monthly income $290. So that's going to be after your fixed expenses. Now, if we take and look at the estimates for maintenance and vacancy, like we talked about in the beginning of the presentation, remember these are estimates. So this pro forma is not telling you that you are going to spend $90 on maintenance or that that's going to be collected by your property manager. It's simply saying that if you were to put aside $90 a month for maintenance, $90 a month for vacancy, that you will start to accumulate funds so that if your tenant moves out or when your tenant moves out, and if there's any maintenance, you've built up a little bit of a cushion so that you're not scrambling going, holy crap, I have repairs that I need to do and I spent all my money, or you don't want to struggle to make repairs on your property. So that's simply telling you to be cognizant of the property class and where your monthly rent is going. I did also want to touch on the leasing fee really quickly. I usually get that question as well. You'll see that the leasing fee goes over 18 months. And the reason that is because we have found that on average, our clients are seeing a tenant turnover every 18 months. So obviously, if your tenant is signing a 12-month lease, some people will stay for 2 years, some for 5. Maybe you're one of the lucky ones who gets a lifer. But on average, we see a tenant turnover every 18 months. So basically what this is saying is that if you put aside $25 from your rental income each month in 18 months, you will have saved that flat fee of $450. So if you guys have questions on that, please don't hesitate to type into your question panel, and hopefully that's clear, because I'd like to move on to cash on cash return. So you can see down here your 15-year projected profit, 70,000, and your 15-year return on investment, 14.25. And now we're going to switch gears and we're going to look at cash on cash return. This one is much more simplified than the return on investment, as it's only going to take into consideration 2 things: your annual net cash flow and the total amount that you invested into the property to begin with. So what does that look like? For this property example, the annual net cash flow is $1,030 and the total invested was $32,000. Now keep in mind that that $1,030 is after those estimates for maintenance and vacancy and your leasing fee. So that puts your cash on cash return at 3.14%. Now, we also want to look at what the performance is without maintenance and vacancy, because even though we know we're going to have it, we don't know when. So I personally like to look at the best my property could possibly be and also what could be if it's not the best. So what does that look like? After fixed expenses only, your annual net cash flow may be closer to $3,900 and your cash on cash return may be closer to 10.63%. So I want to show you guys these numbers so that you can see what the best, again, and maybe worst case scenario is, because there's not going to be maintenance every single month and there's not going to be a vacancy every single month. But as they will occur, there are definitely estimates that you need to take into consideration. So this is where you can find that on the financial calculator. And you can also see the other figures for this property as well. As I mentioned, each property has its own calculator that automatically populates with all the figures. So you can see your fixed cash on cash return with just those fixed expenses. You can see the total after all of your estimates. And there's also your return on investment for this property as well. So the calculator is on the website as well, not only attached to every single property, but there's also a blank template. A lot of our clients will look for inventory on their own on a website such as Zillow or Redfin, and they want to see what those financials look like. So they'll use our template to plug in the numbers and see if those are suitable for their investment plan and their strategy. And we also offer it as a means of plugging in those numbers and then creating your own pro formas. So definitely, as I mentioned before, take advantage of all the tools and resources that are on the website. It's very user friendly and there's a lot of good stuff there. Let's hop into management, and I do apologize, I'm over my 1 hour time limit, so I hope you guys can stay, and I hope we can keep most of you guys on for the rest of the presentation. And for those of you who do have to jump off, keep in mind that this is being recorded and a link will be available on the Marshall Reddick website tomorrow. So if you do have to leave, keep in mind that you will be able to watch the rest of the presentation at a later time. So let's talk about property management. As I did mention, Marshall Reddick is a property manager here with our office in Orange County, in San Antonio, in Austin, and in Clarksville. And not only with Marshall Reddick, but for any property manager, there's some things that are important to look for, and there are certain things that set management companies apart from others. So number one is a strong website, but even more than that, the software. If the software is not user-friendly and it's hard to get statements and it's hard for you to look at the status of your rental income or maintenance invoices, that can really be troublesome for an owner. So good software, easy to use is really important. Maintenance conflict of interest, is it in-house or is it third party? A lot of management companies who employ contractors will give you a markup on maintenance. And that can lead clients to wonder whether or not the maintenance is actually needed or if it's just a means of the management company trying to make money. So if your management company is using third-party vendors and getting invoices from the vendors and passing them along to you, you can compare those numbers and make sure that they're the same. Nope, that happened a little faster than I was anticipating. So you also want to, check the service. If you're interviewing management companies, give them a call. If somebody doesn't answer, leave a message, send an email, and try to track how long it takes them to get back to you. There's a lot of management companies out there that will offer really low rates, but remember, a really low rate can also mean really poor service. So, the age-old saying is you get what you pay for, and that's definitely going to ring true for property management. Finally, online reviews. You want to watch this a little bit though, because tenants tend to complain more than owners do, especially when things go wrong or they need to get in to, fix something, or, if the tenant's getting notices because they're perpetually late paying their rent, then they may not have the same experience with the management company as an owner does, who is appreciative of their tenants getting those notices to perform when they're paying rent late. So online reviews are important, but make sure you know who's writing it and what you're reading. And then finally, a cancellation policy. I've worked with several management companies that had very hefty cancellation policies, and it's really something that rubs me the wrong way as an investor, because if I don't like your service and I don't think you're treating me or my property the way that I want to be treated, I want to have the freedom to take my business elsewhere. And locking people into a management agreement with a cancellation policy, whether it's the rest of the year's rent or whatever it might be, can really be a conflict of interest for owners as well. So just a few things to think about when you're interviewing and looking at different management companies. I strongly recommend you use a management company even if you own a property that's in the same city that you live in, for a couple of different reasons. Number one, your manager and your team is going to know the laws and know the rules and the regulations that you may not know. And they're going to take over all the communication between you and the tenant. So another true story. A colleague of mine went to Mobile, Alabama, because he thought it would be a good idea to knock on the door of the property that he owned and meet the tenants. He had owned the property for a couple of years, and the tenants had always paid rent on time without fail, every single month on the first, check in the bank, and he was on easy street with this property, as they say. So he goes to Mobile, Alabama, knocks on the door, says, "Hey, I own this house that you live in, and wouldn't you know, the next month the rent was late." So if you especially are a younger property owner, or you look young, and you get friendly with your tenant, sometimes that can lead to the tenant taking advantage of you simply because they think that you're friends and they don't understand that your property is a business and that you're dependent on them paying their rent on time. So I strongly encourage property management. Here are the fees for Marshall Reddick management. As I mentioned, we do offer management for our California owners, as well as in-house in San Antonio, Austin, and Clarksville. Your rates and fees are going to vary a little bit between markets. So if you're interested in learning more about that, you can go on the website under property management and you can click on the different markets and see how the fees and rates vary as you look into different areas. So some of you might be wondering, Kristen, what does my manager actually do to earn the fee that I'm paying them? And this can range anywhere from 7 to 10%. Marshall Reddick Management is 7% of the monthly rent, but the national average is 10%. So you'll see it vary, again, from market to market. I'm not going to read this list to you because, as I mentioned before, hopefully you guys can all read. But here's just a short list of what your management company will do for you, the services that they provide. Above that, as I mentioned before, it's really important that you work with a team that knows what the laws are, knows what your rights are as the owner, and knows what your tenants' rights are as well, so that if you do find yourself in an unfortunate situation where you need to file a notice to perform or you need to file an eviction, you have a team that's working for you to make sure that that goes as smoothly for you as you can. So you want a team that's going to take care of you and ultimately take care of your assets. So now we've talked about a lot of the cool stuff that is beneficial about owning rental property. But as I mentioned earlier on, there are some risks. And so what are the major risks, the major potential risks with owning real estate? Number one is natural disasters. You know, tornadoes, hurricanes, earthquakes, anything like that. A natural disaster could really put a damper on your day if it happens to damage your property. Property values, as we all saw in 2008, property values can fluctuate, sometimes a lot, sometimes not very much. There can be maintenance on your property and, of course, vacancy. So these are really the four higher risks, I would say, of owning rental property. So how do we try to eliminate as much of that risk as we possibly can? Well, your insurance coverage is going to protect you in the case of some kind of natural disaster. Your coverage is really important, as I mentioned earlier, in protecting that asset from unforeseen events. Property values are going to be determined by the market, obviously, but when we put at least 20 to 30% down on a property so that we have a positive monthly income, then it's a little safer to assume that your income from your property is going to cover your mortgage amount regardless of what happens to the property value. So that's why the guidelines for lending are different now than they were back in the day, where you could just, hey, Mr. Lender, I can fog a mirror. Can I borrow some money, please? Is because a lot of folks back in those days got themselves over leveraged, and that's why they lost several properties. So the minimum down payment requirement is going to help you hedge against any real severe losses when it comes to property values. As far as trying to reduce the risk of maintenance, obviously buying a property that's A class or B class is going to help you improve your tenant quality, which will decrease the amount of maintenance. A new construction or a property that's been newly rehabbed is also, generally speaking, going to have less maintenance for the first few years of ownership. Also, definitely getting a home inspection as part of your due diligence process when you contract and get your offer accepted is going to be really important. And that's because a realtor is not a contractor. A realtor cannot walk through a property and say, oh, this foundation is crooked, or this roof needs to be replaced, or things to that nature, but your home inspector is going to go in and go from roof to foundation, turn on all the faucets, make sure everything drains, open drawers, turn on stoves, make sure that you really have an accurate picture of the condition of the property before you close escrow. And that gives you the opportunity to ask the seller to make repairs, give you a credit for repairs, or gives you the opportunity to back out of the purchase if the property is in such a condition that you don't feel comfortable acquiring and the seller's not willing to help you out on any of that. So if you're ever in a real estate transaction and you are encouraged not to get a home inspection, you should definitely run, and you should run away fast. And finally, vacancy always is a risk, and it's something, as a property owner myself, whenever my management team tells me that my tenants are moving out, I'm always like, oh, that's not really the news I wanted to hear today. So again, buying in major metropolitan areas means a larger tenant pool and a larger net that you can cast for new tenants, which will keep your vacancy period lower. A professional property manager will get the house cleaned up and marketed very quickly. And a higher property class, again, that A-class section of properties has a lower vacancy rate estimate than the other classes. So sticking with those are really important. I had a client who owned a property somewhere in Oklahoma, and he managed it himself, and he couldn't figure out for the life of him why it had been vacant for 6 months. And I can tell you why. It's because he managed it himself, and he lives in California and his property was in Oklahoma. So it's very difficult to show a property, to interview tenants, to vet tenants when you are literally across the country. So that extended vacancy rate was because he did not have a property manager. He did not have somebody local in that area to rent that property when it did become vacant. So what's next? I want to thank you guys all for sticking around with me. I know I'm past my 1 hour time slot that many of you were expecting. We're going to do one more quick poll for those of you who are still with us. To get an idea for what your time frame looks like. This helps us to help you with your planning, with connecting to the right parties, and helping you guys to, really get the information and details that you want and need to take the next steps or get the next piece of information that's important to you. So I'll go ahead and let the last of you guys make a selection, and we'll share that too. So it's a toss-up for those of you who are chomping at the bit and those of you who want to give yourselves 6 to 12 months. About a quarter of you are about a year or so away, and 10% may be looking at doing something before the end of this year. So I love the broad range of timelines and readiness that we have on tonight's webinar. Looking forward to learning more about what everyone's timeline looks like and why their particular timeline is as such. So for those of you who are looking to take the next step, you can do so by scheduling a free consultation. As I mentioned, all of our services are 100% free. You're always welcome to send me a check. You can make it out to Kristen Tabar. Just kidding. But your consultation is free, and if we hop on the phone and we have a conversation, and at the end of the conversation you say, Kristen, this all sounds really good, I'm really excited to invest and I'd love to work with you, then we'll talk about what those next steps look like, and we'll get you guys dialed in. If at the end of that conversation you're thinking, Kristen, this just really isn't for me, I'm not ready yet, don't think I'd like to take the next steps, then that's totally fine too. I'll still say hello when I see you at the grocery store. And if in the future something changes, I'd love to hear from you. And if in the future something doesn't change, then of course, I always wish everyone the best in their investment endeavors, regardless of whether or not I help you with it. So my contact information is all here. For those of you who are already working with other advisors here at Marshall Reddick, I know they'll be excited to follow up with you guys as well. And take a look at your own investment plan. So again, kind of going through this, and now that you've seen the presentation, you can see all of these things really do fit together. So your why, how, when, what, where, and who are all going to be intertwined, and they're all going to work together. And why is that important? Why is it important to build a plan, to have a goal, to have somebody else help you with that? Well, because ultimately you want to have an investment portfolio that you can build upon to get to your goal. So this is a snapshot of mine and my husband's personal investment portfolio. We started, and the condo in Scottsdale is what my husband calls BC, before Kristen. But starting in 2011, those are purchases that we made together. We've done some single family homes. We see, sorry, somebody just said you could only see the poll question. I apologize, I didn't hide it. So let me go back. We'll do this because I was already talking about it. Sorry again, guys. Thank you so much for letting me know that I didn't hide the poll question. And hopefully you were all still listening, even though all you could see was everyone else's investment time frame. Anyways, back to the investment portfolio. We have purchased some single families. We own a couple of duplexes. We've also done some hard money loans. So in addition to making sure that all your criteria work together to get you to your goal, diversification is also something that's important. So that's why it's appreciated by many of our clients that we offer the free consultation and the free mentoring, because something like this is very difficult to do on your own. It's a benefit to have someone to bounce ideas off of, to kind of run things by. I don't know about you guys, but sometimes I'll think about something, and as soon as I say it out loud, I think either, ooh, that's a terrible idea, or, oh, yeah, that's a really great idea. So it's beneficial for a lot of our clients to be able to have that opportunity to speak with someone who has done what they're looking to do. So I am always willing to talk about my personal experience and my portfolio. You guys can see I own property in Scottsdale, Indianapolis, Memphis, and Cape Coral. So I am spread across a couple of markets. I know a lot about each of them, and I'm always happy to talk in more detail. I got the question for my contact information again because you guys were looking at a poll question instead of my info. And luckily here it is again. So that's my email address and my phone number. That's my cell. So for those of you who would prefer to text and schedule a call that way, or would like to email and schedule a call that way as well, a lot of my clients do prefer not to be caught off guard when they want to have a serious conversation about rental inventory. So please don't hesitate to reach out. And if you'd like to schedule a consultation on the website, you can use that link below as well. And I want to thank everybody for sticking with me. It's 5 to 8. I know it's getting late now. It's deceiving because it's light outside. But I want to thank everyone so much for joining me. And I really look forward to speaking with everybody. If you have questions or want more information, please reach out, and look forward to following up with everybody. Have a wonderful evening, and we will talk to you guys very soon.